Hello and welcome to the Corporate Storytime podcast series. My name is Lucas Robinson, the host of the podcast. On this pod, I'll get the opportunity to talk to ASX company leaders and innovators as they run through their personal executive journeys and the stories behind the companies they are helping to grow today. I'll be leveraging my experience as a former stockbroker and my current role with investor relations consultancy, Corporate Storytime. But enough of that. For now, let's gather round, come in close, and let me tell you a story. Hello, listeners to the Corporate Storytime podcast. Today, I'm hosting Brightstar Resources Managing Director Alex Rovira, who last featured on the podcast in May 2024. Since that time, Brightstar has been incredibly busy in the field and on the corporate front, and has expanded their presence within the Laverton and Menzies districts into a new frontier at Sandstone. Alex, it's been a whirlwind period for Brightstar. Firstly, on the M&A side of things, the last time we spoke, the Linden acquisition in Laverton had been announced. It's since been settled and is now part of the Brightstar Group. Undaunted, you've also announced a foray into the Sandstone district via the acquisition of Alto Metals and the Montague East Gold Project. Can you explain the motivation for opening up a third West Australian gold hub at Sandstone?
Sure thing. And thanks for the time, Lucas, and thank you everybody for listening. So it has been a busy time on the corporate front for Brightstar. The last time I joined this podcast, we were discussing the benefits of the Linden Gold transaction. As you rightly say, it's subsequently been completed. That officially completed in late June. For us, the opportunity to assess entering into the Sandstone district was something that, for me personally, has always been of interest. I geologically really like that area of Western Australia. I think it's lacked systematic exploration and a big budget. I think that whole district can be best characterised by fragmented ownership. Logically, it makes sense at the right time to try and bring all that under the one corporate umbrella. I think the exploration upside at depth is significant and real. There's been a lack of drilling below the top 100 or 150 metres vertically, across the respective packages of ground, and the opportunity to try and do a merger by way of a scheme of arrangement with Alto Metals and also acquire the Montague East Gold Project from Gateway Mining contemporaneously really signified Brightstar entering that district, quite aggressively, essentially acquiring 1.5 million ounces located on granted mining leases with, significant exploration upside. And for us, we're really excited about getting into that ground. We're looking to commence a drilling program in the next few weeks up at the Montague East project. And once that completes, after about a month or so, we'll roll that rig down to Sandstone. So we're not going to waste any time. We want to grow that resource quite quickly. We want to make it a lot better in the sense that it requires further infill drilling and some diamond drilling to improve our structural understanding of the various settings. So we're really excited about what that package holds and really about the synergies and the upside it brings to the broader Brightstar portfolio.
So just talk about the broader Brightstar portfolio. Where are you at now with your mineral resources post the completion of the acquisition of Alto and Montague and bringing Sandstone into the picture?
So pro forma, including the successful completion of the Alto deal assumed, that'll bring our total mineral endowment to about 3 million ounces. Importantly, they're all located on granted mining leases. We feel that the areas that we're in are very attractive for developing a gold mining business. The reality is Menzies, located on the Goldfields Highway, a number of mills in the district. We see that as being a really good opportunity to enter into toll milling agreements and trying to monetize that asset base that way. The Laverton hub, where we have a currently operating mine at Second Fortune, we also have our own infrastructure. So looking at the right time as part of the DFS underway next year, looking at refurbishing and restarting those operations and really using that infrastructure as a hub and spoke, as a central processing hub for the Laverton ounces. We've done quite a bit of drilling in the last 6 months. I think we've done probably 40,000 metres of RC and diamond drilling across the group. that really is feeding into resource upgrades across the projects. So we would see a resource upgrade for the Lady Shenton deposit at Menzies, and really that's the deposit we're looking to mine as early as next year. We've put a number of diamond holes and RC holes into the Fish and Lord Byron deposits, which comprise the Jasper Hills asset that we acquired from Linden Gold. Ultimately, we see Fish at the Jasper Hills project is probably the next mine cab off the rank for our business. There is potential for a relatively low capital cost entry into a modest underground mine there, and really replicating the success and the business that we have over at Second Fortune. So there's a scenario in which we would like to think that we could be next year having 2 operating underground mines and looking to bring online Lady Shenton at Menzies, Lord Byron at Jasper Hills, and also Corktree Well thereafter. So the exploration work that has been going on at the moment for the last 6 months in our portfolio is really moving all those projects forward towards production opportunities. We will see resource upgrades across the group. So as I mentioned, at Menzies, Jasper Hills, Second Fortune as well. And really that's kind of bringing our current business into the DFS stage and near-term development. From a sandstone perspective, as I mentioned, we are having a rig rolling out there early in November. Ultimately, that drilling is largely going to be infill up at Montague to begin with, and then infill and extensional by nature down at the sandstone package. Again, the opportunity for us, as I see it, is not only to grow the resources that we have in the sandstone district, but really to take those towards where we could be in a position as a business to be trying to articulate the true value of what those assets look like. And by that, I mean releasing an economic study. So we would be ideally targeting a scoping study level document by the middle of next year. To do that, obviously, there's quite a bit of infill drilling required to get the measured and indicated ounces to a certain percentage. But ultimately for us, there's a significant endowment there. We are very interested in showing what might optimize in various open pits, what would be economic, what that would look like. I think it's quite rare to have 3 million ounces on granted mining leases in the Eastern Goldfields in WA in a business of our size, when we've got an operating mine at the moment and some lower risk, lower cash flow hurdle requirements to develop a number of other mines. So really the strategy of walk before we can run. Let's develop this business organically. Let's grow these assets incrementally, and really the sandstone acquisition for us was a way to turbocharge that growth. And really that's the asset of scale. But from a production perspective, it is 4 or 5 years down the track. So really from a synergy perspective, the sandstone transactions really gave us that medium to longer term growth profile. So the next 0 to 3 to 4 years is going to be characterised by production opportunities at Menzies and Laverton. So whilst there are no clear geographical synergies, we feel there are strong operational synergies whereby we can be mining our current projects and using the cash flow from those production to help organically fund the exploration and development costs up at Sandstone. We're very excited about what a big exploration budget could do there. We've committed to doing at least 50,000 metres of RC and diamond drilling next year across the Sandstone portfolio. And I think that's really going to show the market and ourselves the calibre of that goldfield and really what the scale of those operations could be in the future.
Yeah, well, that sounds really exciting, and you've articulated the strategy behind the sandstone acquisition really well, and 50,000 metres of drilling going into that project over the course of the next 12 months or so. Yeah, I'm sure you're going to uncover a lot more ounces. And, starting from a base of 3 million ounces in resource at the moment, and as we were talking before the recording, at 4,100 Aussie, that is a hell of a lot of value you've got in the ground that you've defined already. And as you say, you're moving towards studies on the development to extract these ounces. And I know that you're sort of on the record as targeting 100,000 ounce a year production scenario over the course, you're hoping to get there in the next few years. I know one of the useful ways that you've sort of been able to articulate the value proposition for Brightstar are using ratios such as EV to resource ounce and then EV to production ounce. Can you just run through, where Brightstar rates in terms of those ratios and against your peers?
Yeah, great. Yeah, great question. So I suppose those kind of high-level metrics are useful for comparing apples with apples, in the sense that, a traditional explorer or developer company might look at an EV per resource multiple, and it's just a way to benchmark projects against each other. Now, it's an imperfect method because obviously there's nuances between ounces, open pit ounces v underground ounces v, let's call it the mineability of potential ounces, the grade, etc. So it's not a kind of all size fits all approach, but I think from a market, it's a good way to kind of, at least from a broad brush perspective, ring fence some value against projects. So for us, we're trading on a pro forma at the moment of around about, again, pro forma including Alto, about $50 per ounce, $50 to $60 per ounce. It's worth noting that the Alto acquisition and the Gateway acquisitions proposed would be at a valuation of about $35 an ounce. So from a Brightstar business perspective, it is and was accretive for our company to be looking at those transactions, in the sense that we are on paper acquiring ounces cheaper than we're currently trading at. Now, again, I've mentioned it's not the be all and end all, but it is a good first pass where we kind of see. The EV per production ounce methodology obviously would be more appropriate for production companies. For me, that's something that's interesting to track, is almost a guide to how the market's looking at production. And ultimately, it also looks at the enterprise values. It really encapsulates, I suppose, views on future production and future growth. So really, it's almost a forward-looking kind of model or multiple for mine. So at the end of the day, for example, some of the companies that trade on larger EV per production ounce multiples, being Ora Banda, Genesis, Emerald and Capricorn, for example, are all at the far left-hand side of that, being the quote unquote more expensive multiples, really is pricing in future growth. It's pricing in Ora Banda, almost doubling its production from last year. Genesis, significant increase. Emerald and Capricorn, both very successful operators with long histories of success, but also have really good development stage assets in the pipeline. So the market is almost valuing those as where they might be trading in a few years' time. Now, those we ran the numbers a number of months ago, and I suppose the West Australian, let's call it mid-tier, intermediate producer, so sub 150,000 ounces per annum, we're trading at about $11,000 a production ounce. Having looked at those recently, that's gone up quite significantly. You've seen significant re-ratings in some of the names I've mentioned and other producers. So really the market in this gold price environment is valuing cash flow, production, and also organic growth. Now, that is useful in the context of assessing where Brightstar could be in the near term, in the future. As you mentioned, we're looking at being a circa 100,000 ounce producer over the coming years. We showed in our previous studies, which are going to be the subject of the DFS, Menzies delivering circa 30 to 40,000 ounces per annum. The Jasper Hills assets doing approximately 35,000 ounces per annum. We have the operating Second Fortune gold mine at the moment, which for reference last year did about 15,000 ounces. So you start to consolidate or group all of those potential production figures with our different kind of operating hubs, and you can see where we can get to, where we are targeting that production in and around that 80 to 100,000 ounces in the next year or two. And really then you back solve it against your peer group multiples, and you can start to see that there's some big numbers that start spitting out with respect to some of our peer groups. Now, obviously there is nuances with respect to toll milling versus your own infrastructure. Obviously there's the whole piece on margin and profitability per production ounce, but it is a good way of grouping the sector from a production perspective. And if it's $11,000 or $12,000 a production ounce times by 40, 80 or 100,000 ounces per annum, what you can see there is those implied valuations for our business is many multiples of the current market cap. So really that's the opportunity for us is to walk down this pathway of developing the mines sequentially, organically, in a sensible, prudent manner where we're not diluting ourselves too much or we're not taking on too much debt or hedging, and really building out the business in a practical, prudent way. And if we can execute on our strategy and we can trade in line with our peers, then there is significant potential for a re-rating. And ultimately, that's why we're in this business.
Yeah, for sure. And that's why shareholders continue to back you. The scoping study that came out last year talked about the key advantage of having the mill at Laverton, the Brightstar mill. Can you just run through, the advantages of having that mill in terms of the replacement sort of cost of it versus the refurbishment cost that you envisage?
Yeah, absolutely. So for us, that is a key part of the development strategy. Having our own infrastructure is important, certainly in this gold price environment. Ultimately, having your own infrastructure enables you to capture that margin and not pay someone else's processing costs. So for us, refurbishing that infrastructure is important. What's transpired since that study came out in September last year was obviously the acquisition of Linden Gold, which delivered the Second Fortune, Fish and Lord Byron deposits to our business. What that means, and combined with our other ounces and assets in Laverton, is that we've got the critical mass to underpin, I suppose, larger production scenarios. So we are assessing the opportunity to make that mill a little bit larger than what we previously envisaged. Reason being, as I mentioned, you've got high-grade ounces coming out of the Second Fortune and proposed Fish undergrounds, and then you've got baseload open pit feed coming from Lord Byron and Corktree Well. So that infrastructure is important to us. The head start it gives us from a permitting and cost perspective is enormous. In this day and age and this kind of political environment, it is probably a 2 to 3 year period to get something permitted for ultimately to have a processing infrastructure on site. So that for us gives us a significant head start on ultimately building something. Then there's the cost perspective. Again, having haul roads in place, tailings dam in place, certain bits of equipment and infrastructure that can be reused or refurbished gives us a really good head start from a capital perspective. So we see that asset as giving us significant time and cost benefits versus being a greenfields developer.
Yeah, most definitely. I mean, you've just been going hell for leather over the last, couple of years, both, with the exploration programs, but also corporately. It is a great time to be in the gold business. It's never been better in terms of the revenues that you can achieve from selling a gold ounce. So I'd just say congratulations and keep going. You're building something really significant here, and I don't know if there's anything else you want to leave listeners with before we sort of sign off.
Look, I suppose overarchingly, we are very committed to building this as a business. We have been aggressive both with the drill bit, but also through M&A. Look, we still have aspirations to continue to be acquisitive. I do think that in this market, scale is important, both from an operational perspective and also a relevance perspective to the market, to other potential corporates from an M&A appeal or just conventional equity investors. So we are about building a business of scale. I think is probably the most important thing, and we've got the team in place to execute on it. We've been really successful in attracting and bringing in some very talented operators and individuals into our company that have deep experience in running mines, building mines from scratch, building companies up across both the public and private listed space. So, I feel like personally that we've been really successful in getting the pieces of the puzzle in place that's going to enable us to execute over the coming years. It's exciting time. As you mentioned, gold price is obviously having its time in the sun. I personally can't see any reason for that to pull back, materially or meaningfully from where it is. One would argue we haven't even seen the true tailwinds of, I suppose, the easing environment we're kind of entering into now from an interest rate perspective. So conventional wisdom would suggest that, there's potentially still those tailwinds to play into it. Geopolitical concerns around the world, central bank buying, there's a lot of stuff that's, pivoting from what was a headwind for gold to now being a tailwind. So ultimately, it's probably been the best time in the market for the last 4 or 5 years to build a gold business. We've got record high gold prices. We've had, unfortunately for the industry, but there has been some machinations in I suppose the mines with respect to nickel and lithium and a few other things. So access to labour, employee retention, operators, they all speak to the cost line. So I think basically it's probably been the best environment it has been in the last few years to try and build a gold company in Western Australia. So we're very committed to it. We're focused on it. Everything that we're doing is being employed in place to execute on that strategy.
Well, that's great. Well, may the sun shine on you for a lot longer. And congratulations on the job you've done to date. And I know you've got the team and the strategy to keep executing and delivering for shareholders. So congratulations.
Thanks, Lucas. Appreciate your time, and thank you everyone for listening.
Thank you for listening to the Corporate Storytime podcast. We're really trying to build our audience for the podcast and aim to deliver regular episodes of our chats with executives from some of the ASX's most interesting companies. If you enjoy the show, please share it with your friends, follow the podcast and give us a like wherever you download it. And if you have any feedback, please drop us a line at info@corporatestorytime.com. Thanks and all the best.